Stocks, shares, fractional shares, bonds, index funds, ETFs, fixed income, equities, bear markets and bull markets. With language like this, it's no wonder why it seems so complicated and so difficult to get started investing. But don't get put off by the complexities and the confusion of this type of terminology, because in today's video I'm going to strip things back to basics and we're going to talk about not only how but why you should be investing into the stock market. This video might be a little bit longer than the usual 10 minutes, so kick back, relax, grab a drink and let's get straight into it. So let's dive straight into it and talk about why you should invest your money. It all comes down pretty simply to one thing, and that one thing is something called inflation, as defined on investopedia.com as the decline of purchasing power of a given currency over time, or in simple terms, the value of our great British pounds declining in value over time because the costs of goods are going up. The reality is a lot of people are working and saving in order to stockpile cash ready for retirement and only earning a pittance of an interest rate along the way, probably less than 1% in today's climate, and that's probably if you're lucky. But the Bank of England have set out a target inflation rate of 2% per year, which essentially means that the cost of goods and services on average will also increase by 2% per year as well. But if your savings are only increasing in value to the tune of 1% per year or even less in today's current low interest rate climate, then technically speaking you're becoming less wealthy year in and year out relative to that of inflation, which is why it's so important to invest into asset classes that can actually outpace the rate of inflation in order to actually increase your overall real wealth. Which leads me on perfectly to talk about what assets can you actually invest into. Now typically there are 5 different asset classes in which you can look to invest into, and we'll break them down from kind of the lowest risk right the way up to the highest risk asset. The first asset class is cash, and well, cash is just cash. You can't really do anything with it apart from put it into your piggy bank or under your mattress. And as we've already discussed, cash loses its value over time. So because of that, it's not wise from a financial point of view to just have stockpiles of cash sat around doing absolutely nothing, and instead we need to get that money, we need to get that cash working for you instead. Which leads me on to the second asset class, which is bonds. Now bonds is simply just another word for taking out a loan. Just like you would take out a loan from your bank, you would pay them a rate of interest in order to borrow that money. But with bonds, it's flipped the opposite way around. Instead, you would lend your money in return for a fixed rate of interest. Now, typically, there are 2 different entities that actually issue bonds. First up, you've got governments, and therefore they issue government bonds. And secondly, you've got companies who issue something called corporate bonds. Now, you can assume that your money is pretty safe for the most part when you're investing into bonds. It's certainly a lower risk and lower return asset class. The reason for this, you wouldn't necessarily expect a government to go bankrupt, albeit it has happened in the past, like we saw in Greece in 2007. So because of that, investing into the right bonds is certainly an important thing to consider. To identify how risky a bond is, you can look at something called a credit rating, whereby for me personally anyway, I'd only ever look to invest into bonds that are of investment grade rather than that of junk bonds. The third asset class is commodities like gold and silver. Historically, these have been the asset class of choice in order to preserve the value of your money over time. One of the key characteristics that preserves the value of silver and gold is the fact that they're scarce resources. So because by definition they're limited in supply, providing there's still demand for that resource, over time they'll steadily go up in value. And as a result, many investors will use the likes of silver and gold in order to diversify their investment portfolio in order to capture an asset class that's slightly more stable over time. The fourth asset class is property or real estate. I own the property in which I live in today. Well, I kind of don't really own it. The bank really owns it because it's got a mortgage on it. But nonetheless, thanks to prices going up over the course of the past couple of years, I have managed to gain quite a bit of equity in this property. But the big difference here is that I don't actually class my residential property as an investment. But one of the ways in which you can turn property into a form of an investment, from my perspective anyway, is if you buy a property and then rent it out to some tenants, and in essence the tenants then pay the mortgage back on that property. The only real downside to this is that there is a very high barrier to entry with investing into property, driven by the fact with a normal buy-to-let mortgage you're probably looking at about a 25% down payment on the house. So for someone just starting out investing, it's probably not the ideal strategy in order to get you started. But having said that, if you do still have a desire to invest into property, there are other investment instruments out there in order to get you that exposure. One of those investing instruments being called a real estate investment trust, or REIT for short. It allows you to invest into, well, property companies like Realty Income as an example, who predominantly invest, and their business model is to invest and purchase both commercial and residential property. The fifth type of asset class is stocks and shares, arguably one of the most popular asset classes to invest into. Now, when I say the word stocks, what I'm actually referring to is a publicly listed company that you can actually look to buy a share of. Now, when you buy a share in a company, you actually gain part ownership of that business. Now, for the average guy like me that doesn't have tons and tons of money knocking about, I do own just a very, very small portion of Apple with my 32 shares in which I currently have within the company. Which means, based on Apple's market cap right now, which is probably upwards of about $2 trillion, this makes my ownership of Apple a very, very small, minute, almost insignificant part of the company. But nonetheless, investors like Warren Buffett, on the other hand, who are one of the most famous and one of the wealthiest investors to walk the planet today, currently has 887,135,554 shares of Apple, meaning he owns just over 5% of the company. Now, as a result of having all of these shares, there are actually two different ways in which you can actually make money from investing into shares like Apple. Firstly, if a company like Apple performs pretty well, like they have done over the course of most recent years, and then they most recently report a very, very strong earnings reports showing very, very strong profits driven by the high levels of sales in which they've managed to gain from both their iPhones and their iPads. This typically would increase the demand for shares in Apple, and therefore the price of the stock would then go higher. The difference between your purchase price and the current market price is your unrealized profit or loss. So for me right now, those 32 shares in which I own in Apple, I purchased for an average cost basis of $108.07 per share. But with the stock currently trading at $151.80 per share, accounting for some minor exchange rate differences, I currently have £925.27 in unrealized profit. Now, the other way to make money from investing into shares is through something called a dividend. A dividend, simply put, is the distribution of a company's profits to its shareholders, where the more shares you own, the bigger the dividend in which you receive. So for example, in the past quarter, I received a fairly small amount of £4.33 as a dividend from Apple, whereas Warren Buffett, on the other hand, received $195,169,822 just in the last quarter alone. Now, it's all well and good investing into a company like Apple that's performed phenomenally well over the course of the past couple of decades, but when you're investing into just one single stock, it's a pretty high risk strategy driven by the fact that you've got all of your eggs in one basket. So in light of that, one thing that you can do in order to spread that risk is to invest into a number of different companies using something called an index fund. Now, an index fund is simply a collection of stocks in a specific industry or geographical location. For example, over here in the UK, we have something called the FTSE 100, which features the top 100 companies in the United Kingdom, including companies like AstraZeneca, Unilever, Diageo, HSBC, and GSK. Over in America, they have something called the S&P 500, which is just the top 500 companies over in the US, and it features companies like Apple, Amazon, Microsoft, Alphabet, and Facebook. Investing into index funds is a great way to diversify your investment portfolio, and it's actually the strategy in which Warren Buffett suggests that most people should follow. So now you know the vast majority of asset classes in which you can invest into. The next kind of common concern, or the common question in which I certainly hear, is that isn't investing risky, and can I lose all my money? Look, I get it, nobody wants to lose their hard-earned money, and that's me included. But I'm certainly not going to feed you guys some BS, because the reality is asset prices do certainly fluctuate. Some days the stock market is up, some days it's down. It's just the nature of investing into a highly liquid market. But having said that, by definition, you can only actually lose money if you buy something at a specific price and then sell it back at a lower price in which you paid for it. If we take Apple stock as an example, let's say that you invested into one share of Apple stock on the 26th of January for $143. But then over the space of the next couple of months, the price of Apple stock fell right the way down to absolute market lows of $116. If at that point you would have panic sold out of that position, you would have realized losses to the tune of about $27, or the equivalent to probably just under 20% of the value of your investment. But if you would have just held out that investment for the next 7 or 8 months or so until today's current market prices, well, as of today, the current price of Apple is $154 per share, and that initial investment in which you would have made would actually be up just shy of 8%. And even if we look back throughout the course of Apple's history, and let's just take this from, I guess, kind of the last 10 years, if we could just quickly find the market price, you could have invested into Apple shares at less than $13 per share, which based on today's current market price would have given you a return on investment of well over 1100%. So don't let the price fluctuations in the short term distract you from the long-term potential of the investment in which you've made. Now that doesn't go to say that all stocks will continue to go up in value like we've seen with Apple. The reason being that some businesses will fail over time. Many companies will fail to evolve and fail to adapt to an ever-changing business environment, and as a result of this poor performance, this will be reflected in their stock price, which becomes pretty much worthless. But to caveat this potential risk that you end up picking the wrong stock, you could potentially look to invest into something called the S&P 500 index instead. Historically speaking, over the course of the past 40 years or so, over the course of the long term, the S&P 500 has always continued to rise in value. Yes, we've had some market dips along the way, which is just part and parcel of a natural market cycle of boom and bust, but nonetheless, over the course of the long term, you can't dispute the fact that the S&P 500 should continue to rise in value. Now, the reason why I emphasize the word should is because nothing is certain when you're investing. The S&P 500 could absolutely dive bomb and simply not recover for the best part of 30 years, like we saw for the Japanese stock market once upon a time. So yes, investing of course is obviously risky, but it can also generate you a huge amount of wealth, especially if you're investing for the long term. And you can simply see this by looking at the net worth growth of Warren Buffett over the course of most recent decades, and he's currently got a net worth of over $100 billion. This is where I certainly want to make the link and certainly make the distinction that when you're looking to invest, you must have that long-term investing time horizon at the forefront of your mind. Because investing for the long term will give you sufficient time to ride out any downside waves in the stock market, or bear markets to use a more technical term, like we saw with the dot-com bubble bursting in the early 2000s, as well as the financial crisis of 2007, and even when the market crashed just in March last year. But alongside that, there are also three other things in which I think you should probably have in hand before you look to start investing. The first one being high interest debt. If you have a high interest rate debt, and what I mean by that is you owe money on a credit card as an example, you probably want to get rid of all of your high interest rate debt before you look to invest into the stock market. The reason why I say that is because not only does the compound effect work to the upside when you're investing into the stock market, but it also works against you when you owe people money and you're having to pay interest upon interest upon interest, which can become extremely costly over time. So because of that, be sure to get rid of any high interest rate debt before you look to focus on gaining more upside. The second key thing is to certainly have a 3 to 6 month emergency fund in place. It's a simple financial principle that I'm sure you've probably heard many times over, but in essence, what you'll need to have is at least 3 to 6 months worth of your monthly expenses held in cash just in a savings account, just in case shit hits the fan. It means that you can rely on your cash buffers rather than looking to withdraw money from your investment portfolio. And thirdly, don't look to invest money in which you could potentially need within the space of the next 5 years. The reason why I say this is, let's say you've got a big life purchase coming up and you're looking to buy your first home, and as a result you've saved thousands and thousands of pounds in order to get that deposit together in order to make that purchase. The last thing that you want to do in order to get that couple of £1,000 extra to perhaps help pay for some furnishings or a brand new sofa or whatever it may be is to invest that money into the stock market, essentially risking it all into the stock market for the stock market to then go on to crash, and you'd be left several years away of achieving that goal of buying your first home. Remember, nobody can time the market, so don't look to take risks with money in which you're going to need within the short term. Then finally, once you've come to the conclusion of the asset classes in which you want to invest into, the risk appetite in which you have, along with your investment objectives and investing time horizon, the next question in which you're going to have is, where can I get started? Well, to invest your money, you're going to need to find a stockbroker. And no, this isn't some Wolf of Wall Street stuff like you see in the films when you call someone up and ask them to buy you 50 shares in Apple. Those days are certainly long gone, but today it's just as easy as downloading an app on your phone, and depending on what country you're in will depend on what apps are available to you. So for example, if you're over here in the UK, you've got apps like Free Trade and Trading 2 on 2, whereas if you're over in the United States, you've got companies like Robinhood and M1 Finance. As an alternative, you do also have a company called Vanguard, who also operates in both the UK and the US as well. Now, I've done various tutorials on Free Trade, Trading 2 on 2 and Vanguard on my channel before, so if you do want to get a little bit more detail and information about these three different brokers, I'll leave some links down in the description below. But for the others, especially if you're based in the United States, just do a little bit of Googling and I'm sure you'll find a pretty good broker out there. But at a high level, Free Trade, Trading 2 on 2, Robinhood and M1 Finance are pretty good for investing into individual stocks and ETFs. Whereas Vanguard, on the other hand, offer a slightly different service. In actual fact, Vanguard have their own Vanguard diversified funds in which you can invest into, but they don't offer the same functionality where you can invest into individual stocks and shares. So depending on what your preferences are will largely depend on what broker in which you use. But in essence, when you're looking for a broker, there's two things in which I'd look for. Number one, if you're over here in the UK, you're probably going to want to look at investing into something called a stocks and shares ISA, because it's a tax-free investment account which you can invest up to £20,000 per year. The second thing is to either look for brokers who are commission-free or just have low fees in general, which includes small account fees as well as transaction fees as well. Then once the account is open, you can then start investing into some of your favorite stocks and ETFs. So I hope you found that beginner's guide to investing pretty useful. If you do have any other questions on investing, be sure to leave them down in the comment section below. And if you did enjoy the video, guys, all I ask is that you drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.